You've heard about the retirement crisis that's looming in America, Social Security shortfalls, unfunded liabilities. The important part of this video is that it doesn't matter what age you are. Something just broke. I'm going to show you exactly in this video the thing that broke, the actual number that broke. 1 point. And the entire structure is under threat. It's going to have all sorts of ramifications for you no matter what your age group, because it's going to affect the way that the world sees the American dollar. It's going to affect the quality of life of everyone around you. It's going to affect your responsibilities. This is so important. Please take a few minutes to learn this message I'm going to show you. I'm going to show you exactly the point that broke, and it's going to change everything. And we'll talk about what are unfunded liabilities, and are they exactly what they sound like, and how significant are they, who are they owed to, and most importantly, what this all means for you no matter what your age is, and also what you can do about it. There's actual steps you should be taking right now that's going to make a big difference, and it's a serious moment now. This is a very serious thing. You need to take a couple minutes just to take in this message. It's going to affect everything. Of course, as Jerome Powell says, some of us are just prone to suffer. So if you're one of those people, maybe you don't need to worry about this at all.
The point is, some people are just really prone to suffer more. I mean, for people who are economically well off, inflation isn't good, it's bad.
Always remember that nothing we say here should be intended as personalized trading advice for you. You need to make your own decisions. You do your own due diligence. We are going to give you our 100% honest opinion, what we believe is going to happen, and we happen to be very educated, very good at this stuff. And always remember that I am wrong 100% of the time. Demographics are so important. This is why you're seeing 3 lost decades in Japan. It's why you can buy a house in Japan now that costs less than it did 30 years ago. There's so many aspects of demographics, and it's so important, and nobody's really talking about this stuff, maybe except for Harry Dent. He's got a pretty good finger on the pulse of this stuff. But this was the point of video 4, I believe it was, or the 4-part video series I made of the 4 economic horsemen of the economic apocalypse. Demographics is going to be a problem starting years ago and going forward for many years from now. In America, as of 2020, we had 329.5 million people in the population. And of that, 76.4 million were baby boomers. That means 23% are people who were born between 1946 and 1964, putting them at 57 to 75 years old. As people age, they go through different phases. Their spending habits change. They may downsize their house, sell their house. They might do a reverse mortgage. But the thing is that the government allows you in your prime earning years to pay less tax by contributing to their either tax-free or tax-minimized savings accounts. And then when you get to retirement age, the government wants their tax money. And they get it then. They mandate that you sell a certain portion of your retirement savings and then pay the tax on that as you do it. My father is an example of this, where he has a certain amount of retirement savings, and every year he has to take a certain percentage of that out. And often what this is going to mean for a lot of people is that you sell stocks. And by the way, the gold coin contest entries are closed as of the end of the month, so if you haven't gotten a photo for the contest yet, do it now. And don't worry if you don't see your photo in this video or any of the previous videos. I've still got a backlog of photos I want to display that are the entries to the gold coin contest. You can learn more about all this at peterleeds.com/coin. But what else is happening? Life expectancy is elongating. Good problem to have, but most people now are looking at more life left than money. Meanwhile, right now, people are using their retirement savings for emergencies. And what's an emergency? When you don't have enough money to pay your bills. Such as now, with inflation, a lot of people are actually dipping into the retirement savings. And people are adjusting the age at which they retire. They're working longer because they don't have a choice. And later I'm going to show you the most important 18 words from this financial document. It's 40 pages long, and of those 18 words, I'm going to show you the most important word in it. But I'm also going to tell you about the one point, the one number that broke. It's almost like a treehouse being held up by a whole bunch of branches. One of these branches just broke. And it doesn't mean that the treehouse collapses. It means that it at least sags and maybe collapses. But what's the one point that all of these things rely on? The pension funds, Social Security, it all predicts or it bases their numbers or expectations on an increase in their investments in the stock market and bonds of annually 6%. As long as they're making 6%, some of them are as high as 7%, 8%, depending on if it's a state pension. No matter what, they're predicting that there will always be a certain amount of growth in the investments in the stock market. That's all well and good. Except what happens when that branch breaks? What happens when investment returns from stocks don't go up 6 or 8%? That branch breaks when the stock market returns are going negative, like we've seen right now. The markets were up 25% last year. They're down 25% this year. That throws all of the numbers out the window. They said, we can't pay you this much in your pension. Here's how much you put in. Here's how much you're going to get. And they're basing all of that on that one specific number. They're saying it used to be 8%. Now they're saying, hey, we'll be conservative. We'll say 6%. And guess what? It's negative 25%. There's not money there. And when something drops, let me tell you this. If something's at $1 and it drops to 50 cents, that's a 50% decline. How much does it need to increase to go back to where it was? You might say 50%. No, to get back to where it was, it has to go up 100% from that point. The effects of these declines is going to be significant and magnified as we move forward. Now, a lot of these numbers are from the Center Square article. The U.S. national debt is closer to 123 trillion, which is more than 4 times greater than what the Treasury Department has been reporting to you. The economy is strong. Our liabilities are only a quarter of what they actually are. This is a situation that you're in. That's also according to Truth in Accounting, a Chicago-based organization that is after my own heart. The federal government has 5.95 trillion in assets. Sounds like a lot, right? And $129 trillion worth of bills. And by bills, they mean liabilities, resulting in $123 trillion shortfall. And that equates to a debt burden per American family of $796,000 per household. Because of this massive amount of debt and reportedly poor financial decisions made by lawmakers, Truth in Accounting gave the U.S. government an F grade for its financial condition. That's a pretty generous grade. I would have given it an F- or a WTF. To go on with this article, it says, assuming the current laws and policies don't change, increases in future debt will grow faster than GDP. Truth in Accounting found the federal government's overall financial condition worsened by $9.84 trillion in 2020, which is resulting mostly from stimulus funding and costs imposed on state and local governments by lockdowns. Are you still with me? It gets a lot worse. Just hang on here. The official Treasury Department figure of $28 trillion doesn't include the amount the government owes in unfunded Social Security and Medicare benefits. Truth in Accounting's total federal debt calculation includes $55 trillion in unfunded Medicare benefits and $41 trillion in unfunded Social Security benefits. Now, if any of this is relevant to you yet so far, and it probably is, if you're retirement age, what do you think happens? What do you think is going to happen when people call on that money and it's not there? Assuming that current laws and policies don't change, increases in future debt will grow faster than GDP. Spoiler alert, they will grow faster than GDP whether or not they change current laws and policies. Debts will continue to grow faster than GDP no matter what we do. That's why I'm always telling you we've lost control of this. Truth in Accounting found the federal government's overall financial condition worsened by $9.84 trillion. I'll say that again, $9.84 trillion in fiscal year 2020. Is that okay to you? Does that make sense to you guys? And they go on to say that that debt is resulting from stimulus funding and costs imposed on state and local governments by all the lockdowns. And here's one of the ways that they play tricks on you and they think you're stupid and they manipulate you. The official Treasury Department figure of $28 trillion doesn't include the amount the government owes in unfunded Social Security and Medicare benefits. Unfunded, they have the liability. The money is owed to somebody. Who is it owed to? American citizens, firefighters, teachers, anybody with a pension. And they're admitting that they don't have the money for that. And so they treat it differently. We just can't pay that. It's almost like getting your credit card bill and you say, okay, I owe all the money that I bought, food and my automobile and this and that. And then I'm not going to count or consider anything that I spend money on for entertainment. It's different. It's entertainment. So I owe $10,000 on my credit card, but only $6,000 of that is for things that aren't entertainment. Entertainment is a different thing. That's exactly what they're doing. And when I say they, I mean the powers that be, being politicians, the government, the Federal Reserve. One reason why the Treasury Department excludes unfunded benefits from its debt calculation is because it claims recipients have no right to future payments. This is a very, very important part. Listen to this very carefully. They only have rights to claims through current entitlement laws. Additionally, government documents indicate that laws to reduce or stop future benefits can be passed at any time by Congress. That's telling you that they can just change the rules, change the game, shift the goalposts. They don't have to pay you. It's actually legal in the documents. It says right there in black and white, we don't have to pay you. This isn't money that they owe. It's just money that you might have the right to a claim through current entitlement laws to it, but we don't owe you that money. That's what they're telling you. You see how they're setting this up here? They're going to let people fall off the cliff, starve, die. They're allowing this because they're doing what they think's best. And at the end of the day, the way it's all structured, you're getting the short end of the stick in every possible way. And so what happens? Unlike many state governments that have rainy day funds or cash reserves, which they're blowing through, by the way, anyways, the federal government resorts to printing and borrowing more money or raising taxes instead of cutting spending. They might not pay you. They don't have to pay you. They are going to raise taxes and they'll cut spending too. And I'm going to show you in just a second how fraud rates are on the increase. And that's implying something. It's showing you something. First, I'm going to go through the most important parts of this 40-pager, and don't get scared. It's really short. I just have certain highlighted words and sentences in this that we're going to go through. So we'll go through it really quickly. You're about to learn a whole bunch of stuff. This is an article from the Pew Charitable Trusts about the state pension funding gap. 2021 fiscal year, the best condition since the Great Recession of 2007-2009. And some of these state pensions are doing a little bit better than they did during the global financial crisis. They took a huge hit during the recession. And now they're coming out of that. And one of the ways they're doing that, and pay attention to this, very important. One of the ways they're doing that is by forcing you to contribute more to it. We're seeing pension contributions increasing by a certain amount every year with a lot of these pensions, and those increases, combined with the incredibly strong performance of the stock market, have made it so that a lot of these pensions are saying, hey, look, we're getting better. Even though they're still horribly underfunded, they're like, we're not as bad as we used to be, and we're on a good trajectory. And they are, as long as that stock market keeps going up 25% a year. But what if the stock market went down 25%? Pew found an increase in assets over $500 billion in state retirement plans, fueled by market investment returns of more than 25% in fiscal 2021, the highest annual returns for public funds in over 30 years, and substantial increases in contributions from taxpayers and public employees to pension funds. And the four worst states of all are New Jersey, Kentucky, Illinois, and Pennsylvania. Nearly every state has enacted benefit reforms to lower costs, including cutting benefits for newly hired public workers. When they say benefit reforms, they're just saying that they're going to give you less. So you have to pay them more in contributions and get less. That's the phantom retirement crisis right there. There's a lot of things getting worse and some making the big headlines. It's not like a default or somebody not getting any of their pension. They're just getting less for it. and they're paying more into it. They become more disciplined in terms of managing the pensions by using tools such as stress testing to determine how twists and turns in the economy might affect pension funds. Why don't we just skip to the chase, where I'm going to tell you how it's going to affect pension funds. Twists and turns in the economy, how they might affect pension funds. Let me take a crack at it. If the stock market is declining in price and they're basing all of their numbers, all of their payouts on, and what they can afford to give you, basing all of that on the fact that they're making money in the stock market, that's all well and good, as long as you're making money in the stock market. And here's the most important 18 words out of this 40-page document. The first time this century, states are expected to have collectively met the minimum pension contribution. That's the most important sentence in this document. And the most important word from that sentence is century. For the first time this century. A year is a year, a decade is 10 years, a century. You don't even live a century. Pew identified a sizable funding gap between what states had promised their retirees and what they had put aside preceding the recession. A gap that ultimately grew to over $1 trillion, and that's back in 2015. Pew now projects that the gap, or unfunded liability, could fall below $1 trillion due to a combination of policymaker efforts and windfall investment returns. But they're basing it on windfall investment returns. That's a thing that comes and goes. You can't say, oh, we had great investment returns, so we're in good shape now. Let's just plow forward, everybody. And the point is, do you see how insane this is? We're talking about little bits of differences in numbers, but we're talking about trillions. We're talking about trillions. So what if the market goes up 50%? There's not enough money. This is going to come home to roost, and it's going to affect everybody, not just retirees. Contribution increases may be difficult to fund without cutting essential services and programs or raising taxes. Another spoiler alert, they will raise taxes. That's why I made that video for you guys saying that taxes will have to mandatorily go higher because there's not enough money otherwise. They're cutting essential services and taxing more and making your contributions greater. This is all the flailing they're doing to try and keep this glorified Ponzi scheme running. There are some successful state pension funds, South Dakota, Wisconsin, and Tennessee, but they're still underwater. And I'll mention to you which of these states are in better shape than others, but the way that these states, Wisconsin, South Dakota, and Tennessee, have maintained high funding ratios over the past 20 years is in part because they have strategies, including policies that target debt reduction and, most importantly, and share gains and losses with workers and retirees to mitigate cost increases during economic downturns. I don't know if you guys are hearing that through the eyes of Peter Leeds, or ears of Peter Leeds. What are they saying here? They're saying that when the stock market declines, as it is now, the pensioners take the hit. They suffer the losses. It's on you. If you say, I'm going to pay for my pension, good thinking, you put money in there, they take your money, put it in the stock market. If the stocks go down, that's on you. Decades of underfunding and market losses from risky investments. A lot of them got involved with hedge fund companies to try and, they need to get more and more returns to be able to pay everybody what they owe, the liabilities. And the way they do that, when it's not easy, they start getting into a little bit more risk. Well, we need to make 8%. Well, markets went down, we need to make 28%. Okay, and they just try and keep going for more risk. And a lot of that is backfiring and losing more of the money that you're putting into your pension. The market has experienced a once-in-a-generation rally. That is almost a shift in your focus. You're thinking that the pension is getting better, but it's almost like You're walking across a bridge that's rotting and it's about to collapse, and you're halfway across it, and you're talking about how many steps more you're taking, but you're still right in the middle of a 5-mile long bridge. And they're saying, hey, at least we're walking forward. Those gains were over 25% for fiscal 2021, which translates into gains above the expectations of more than $500 billion. Well, I'm glad that happened. Now we have an extra $500 billion. I guess everything's okay, everybody. So either you're prone to suffer or this is going in the right direction, so we're all good. Most analysts attribute the strong market performance to historically low interest rates and an unprecedented $5 trillion in federal stimulus in response to the issue that we all went through over the last couple of years. Recent projections by the Congressional Budget Office, Moody's, and the Federal Reserve are forecasting a return to pre-pandemic levels of gross domestic product by calendar year 2022 or before. Well, apparently, the Congressional Budget Office, Moody's, and the Federal Reserve is absolutely useless. They should just pay me to consult for them. But here's the part that totally blew my mind when I realized every time I see something that you realize that we are so far into delusional territory. This is an example of it. Listen to this. The Congressional Budget Office expects average real economic growth of 1.6%. We just had a result of, 1.5% that they revised down to 1.3% negative growth, quarter one. They expect real economic growth of 1.6% between 2026 and 2031. And a nominal growth of 3.7% over that same time frame. That's delusional territory. The Congressional Budget Office, which was actually already proven wrong in the last paragraph, cannot possibly know average real growth for 4 years and 9 years from now. They're taking numbers and they're saying, well, if this number says that, then that means that in 20 years from now, 5 years from now, it's going to mean this kind of growth. It's all absolute delusion. But then they go on to say they're expecting growth of 3.7%, which, hey, it's significantly lower than the historical average. Market experts now estimate equity returns, which are related to economic growth and current market value of stocks, to be 6.4% over the long term. So if we're down 25% this year, that means next year, to get these numbers, you got to go up 25%, plus 6.4% for that year, plus 6.4% for this year, to be able to say that 6.4% is what they're anticipating or expecting. This is an expectation which is already proven wrong, and all their numbers, everybody's numbers and pensions, are based on making a certain amount of returns from the stock market. That's the branch. That's the branch that broke, that's holding up the whole treehouse. And pension funds hold 50% of their assets in stocks and 25% in bonds. And we just saw the 40-year bull market in bonds come to an end. We expect typical pension fund return to be approximately 6% annually over the next 20 years. Again, absolute delusion. I'm not saying that they're not right. I'm saying that they don't know what they're talking about. They're trying to just go through the motions. They think they're doing a good job, but they don't look at things the right way. That's why you're being told the economy is strong. This whole time I've been telling you that it is absolutely not strong, and I'm watching it deteriorate. I'm telling you about how it's deteriorating. And they're stepping in front of the microphone and telling you that the economy is so strong, don't worry about it. We've got everything under control. That's what they have to do, whether or not they have everything under control. They have to say that. So 20 years from now, half of these donkeys won't even be around then. But here they go, don't worry about it. This is significantly lower than the historical average of 8%. Markets can change. They're going up, they can go down. So they're saying, don't worry, it was a historical average of 8%, but we're only going to be conservative. We're going to say 6%. So we're being conservative. We're being easy. We're going to make sure that this number is more believable. State pension funds hold about $3 trillion in assets. So every percentage that they bake into the pie, they could say, we think that the market is going to go up 20% a year. We'll bake that in. But they're saying, no, we'll be conservative. Instead of 8, we'll go 6. But they're saying that every 1 percentage point results in an income of $30 billion annually. Highlights the importance of you putting money into the plan. That was a summary of that. They're saying, you see how important it is that you keep giving us money, and now in most cases give us even more money for less resulting benefits? And again, a couple of things here. This affects you even if you're 20 years old. It's going to affect the entire overall quality of life of all of us. It's also going to display that the American government and a lot of these states, they're willing to default. In many cases, they'll have no choice but to default. But the point is that you're not getting the money that you're expecting, that you paid into your whole career. And in all of this research, I looked at a lot of different things. And once in a while, something pops out where I'm like, you guys need to see this thing. I don't do this always, but I do it once in a while when it blows me away. And I really, really want you to watch the documentary from FrontLine about the retirement crisis. And I'm going to put a link to it below this video and at the end of this video. It's 1 hour long, and I just think that you should sit there and watch it from beginning to end one time. It's going to change your life. Illinois, Kentucky, New Jersey, and Pennsylvania have led a trend of increasing contributions, basically getting more money from you. With an average growth in scheduled pension payments of 16% each year from 2009 to 2019, that 10-year period, pension funds required 16% more contributions. Some states did even more than that, but that was the average. So that's over 1.5% a year. Every year, we need 1.5% more. Next year, we need 1.5% more again. And I know I'm jumping all over the place for state-run pensions, private pensions, federal government, unfunded liabilities. It's all different things. It's all one thing. You'll see, it's all one thing. It all results in an acknowledgement that a return to pension plan funding discipline is the only path forward in order to avoid pension fund insolvency. The pension funds, right now, are already insolvent. And they're saying, what they're saying is correct, pension plan funding discipline, but then they go on to say, is the thing that's required so that we don't become insolvent. You're already insolvent, and yes, you need to have pension plan funding discipline. Fiscal responsibility. The federal government, the pension funds, even individuals. All four of those states I mentioned have changed benefits to help reduce future costs. Again, you get less. Kentucky, New Jersey, Pennsylvania emerged as among the worst funded due to a combination of shortchanging contributions, offering unfunded benefit increases, and investments that fell short of expectations. When the 2007 and 2009 recession hit, it further strained underfunded pension systems and forced a reckoning. So, why would the next recession, which is inbound as we speak, why would that recession not have the exact same effect? It will force a reckoning, but it might be the last reckoning we ever have to face. But all the bad things that come with that will be part of that. And that's why now, even Biden was talking about it the other day, about the unfunded liabilities. Maybe now we'll start actually looking at this problem in the face. That is so important to actually recognize that there's a major, major problem here. Illinois, Kentucky, New Jersey, and Pennsylvania have collectively experienced a 300% increase in employer pension costs since 2009. And Pennsylvania is the worst one. 2009 to 2019, they've required increased contributions of 24%. For example, benefit payments grew by an annualized rate of 9% between 2000 and 2007 as baby boomers began to retire in greater numbers. As operating cash flow declines, lower than expected investment performance is more likely to cause a drop in plan assets, which makes it harder for plans to generate returns in the future. We can't give you as much money in the future because the stock market might come down. But if it comes down, you're on the hook for it. This is a clown show. State pension funds typically exhibit negative operating cash flow, the difference between contribution inflows and benefit payment outflows, which is not uncommon for a mature pension plan. It doesn't matter, that's not uncommon. And a mature plan. You have a new plan, a youthful plan, a mature plan. What's the next phase? I forget what comes after maturity. We're almost done here with this stuff, and it's going to get even better. So stick with me here, okay, please. Possibility of insolvency if the trend is not halted. Oh, really? Concerns about having enough cash to pay retirees. Oh, really? Because in a low return environment, the plan could be required to liquidate its assets to keep up with benefit payments. Your pension, your retirement plan, might have to sell a bunch of their assets if they want to pay you, after they've cut your benefits and made you pay more into it. And I won't even get started about the effects that management fees are having on your 401k, which is exactly why I'm begging you to watch the video by FrontLine. This isn't affiliated with me at all. I just was blown away. After I'd done all my research, then I watched the video, and you can really get a feel for the human story in all of this. Go down the list of states. They're all like this. None of these states would come close to passing Leeds analysis. First thing I do is I go to the balance sheet and I look at the quarterlies and I look at how much do they own versus how much do they owe. I'm not trying to be a psychic here or something. I'm just asking you, what do you think is going to happen here? How hungry are the elderly going to be based on how this is all going? What kind of quality of life can they have compared to what they were anticipating to have, what they expected to have, compared to what they were told they were going to have? And the last thing I want to point out about the states is the asset coverage ratio. This is the same concept of the reserve life index I always tell you guys about. How many years of the exact same production rate of extracting the oil or the gold or whatever resource? How many years left at this rate do they have? So what's the reserve life index for a state? How many years do they have at the current expected payouts before they would have run out of money? Iowa is 15 years. Kentucky is 7 years. Connecticut is 7.7 years. Pick a state, they're all like this. Minnesota, 13.8 years. Oregon, 14.4 years. Washington might be among the best with 24.4 years at current rates before they would have run out of money. If that's not enough to show you the current direction that we're in and the eventual destination, then I literally can't help you more than that. But I am going to help you by telling you at the end of this video exactly steps that you need to take now, no matter what your age is. And Kentucky was coming up with all these solutions about what they're going to do, about how they can't afford to pay the people that they promised the money to. And one of the ways that they said, of among many things, one of the things they could do, allow municipal bankruptcy. You know you're going to see defaults, delinquencies, and bankruptcies on the rise going forward big time. And it's difficult to think about a municipality declaring bankruptcy, but they've done it before. They'll do it again. And when one of them goes because of this problem, then there will be other ones that go as well. Bankruptcy should be the option of last resort, but it can help struggling municipalities restructure their debt, renegotiate contracts, and reform pensions. So in other words, we'll do bankruptcy if we have to. But before that, right when we're about to declare bankruptcy, what we're going to do is restructure our debts to you, renegotiate our contracts with you, and reform your pension. This is absolutely inappropriate, unsustainable, ridiculous, unfair. And what is it doing? It's illustrating everything I've told you for the last 20 years. And again, in Kentucky, that might have been Illinois, that last part, but in Kentucky, I was reading about it, they're saying that, hey, investments didn't meet expectations. We expected 8%, 6%, but we got minus 25%. And this isn't this year, sorry, this is before. Investments before didn't meet expectations. And the 25% gain in investments would have helped, but now it's come back, it's given back all of that. So where's Kentucky sitting right now? They're not as bad as Illinois, But all of these states are bad enough that they're going to be unable to recover from. The national economic recession that hit in 2008 caused investment returns for everyone to tank. That is demonstrably inaccurate. A lot of people did okay. They would have been the ones watching this kind of message. PFM, a Philadelphia-based consultant to state government, and that's a horribly branded name. You don't have a business or an organization by the call letters because that puts you in the crowd with everybody. TXC, TLP, IBM, XKL, PTF. You want to brand your organization. You don't want to try and fly under the radar. If you have a business that is the call letters is what you call your business, that's a massive, massive mistake unless you're trying to hide. And hiding from consumers is the actual opposite thing that you probably should do. There is no should. My shrink told me that one time, but that's what I think you should do. PFM attributed part of the problem for the soaring pension liabilities to downturns in overall investment markets. You know, investment markets sometimes go lower. And then when it happens, they say, well, that's why there was the downturn. That's why we have so much liabilities and so little means to pay those liabilities. The markets didn't do perfect. A pay-as-you-go system where the plan uses current contributions to pay current obligations, in other words, a glorified Ponzi scheme. State and local governments and corporations must operate funded plans, while federal governments can resort to unfunded pay-as-you-go schemes. That's all legalese. People are looking too meticulously at this. They're getting too granular. The point is, there's a whole bunch of debt owed to people who paid and are owed the debt. At least they think they're owed the debt. And the wording in the paperwork says, we don't actually have to pay you. And so what's the next step? Stop being a one-dimensional thinker. Let's go dimension 2 and 3. What happens when they say, we don't have the money? What happens to the person expecting the money? What were they going to use that money for? And what happens to them when they don't have that money to buy the things they need, which might be healthcare, might be food, might be toys for their grandkids. It doesn't matter. They paid in, they expected it, and now they're getting screwed over. Everybody is getting screwed over here. And they're keeping it going because they're getting more contributions, and the markets are going up. And that's the point where it all breaks. The markets came down now. So all of a sudden, all the estimates and the numbers of 6% growth are out the window. It's going to expose the vulnerability of all of this stuff. Legal and General Retirement Solutions said it has seen an increase in investors withdrawing from their funds this year compared with last. It was monitoring closely whether this was due to the rising cost of living. Part of it was. It's funny that they put in quotes, monitoring closely. In quotes means that somebody else would have called it that, but that's not what they're saying. That's what quotes actually mean in this case. But what does that mean, monitoring it closely? You just stare at a number and look at it even harder? What do you got to monitor? It's not complicated at all. You guys don't have the money to pay what you promised. Anyways, it is partly because of the rising cost of living. A lot of people are taking money out of their retirement accounts right now because they're paying more for food, energy, etc., etc. In the first 4 months of last year, 5% of pension customers made an ad hoc withdrawal. This year, 18% did. It's going to climb too. It is inevitable with the cost of living crisis biting, people will be more likely to access their savings earlier and then draw down at higher rates, says Emma Byron of Legal and General Retirement Solutions. And this is one quote I'm bringing you out from Pension Age. A record 78% of pension transfers showed at least one warning sign of potential scam activity in April, according to XPS Pension Group's Scam Flag Index Tracker. Fraud is always, as you get closer to the turn from maturity to decline. That's the life point we're at with this. Fraud always maxes out as you enter the decline phase. One more quick interruption here. I noticed in a lot of the photos you guys are sending in for the gold coin contest, there's your kids in the photos. And I realized that a lot of you have kids. I never even thought about that possibility. So what I'm going to do, my commitment to you guys, I'm not going to swear on camera anymore, ever. This represents the 4th consecutive month that the rate of potential scam activity on pension transfers has risen and is an 8% point increase over the 70% recorded in March. So, what is this all telling you? Let's sum it up here, okay? Take everything we just talked about, and it's revealing that we are going to not be meeting our liabilities, which is a default, and people are going to be suffering, and the quality of life overall is going to be on the decline. It's revealing this to the entire world, not just in America. And what's the main thing about money? It's an idea that we all agree upon. If I give you a $20 bill, you can take it to somebody across town and go, will you give me 2 $10 bills for this $20 bill? And they say, yes, that's an exactly equivalent transaction. I will give you 2 $10 bills for this $20 bill. And what's the difference between a $10 bill and a $20 bill? The way that the ink is laid out on the piece of paper and your mental confidence. But the decline in confidence between you and anybody else in America, they won't feel it the same way as the big problem, the decline in confidence among the rest of the world. We already are seeing other countries like Japan and China that own most of our debt. When we have a deficit where we spend more money than we have, sometimes China will give us a few $1 billion. Sometimes Japan will buy a few $1 billion of our treasury bonds. And that helps us cover all of our expenses. But we're seeing there's not as much of an appetite for American dollars overseas right now. And if they start deciding to sell a lot of the holdings they have, that will make it that much worse. Any day China could say, we're going to sell all our American holdings and just crash the entire global economies. America, China, and everybody else too. They won't do that, of course. But I'm saying that theoretically, that's a possibility. The less demand there's for American dollars, the more those dollars will be released into the wild, I always say, and they find their way back to our shores. It's only going to stoke inflation further. But speaking about inflation, when everybody's screaming about inflation is going to go through the roof, I told you it wasn't. And now we're starting to see signs of it starting to slow down a little bit. And I told you that the inflation will increase as long as there's a port lockdowns. The ports are much more efficient now than they were a year ago. They're starting to work through this backlog. They're getting there. They'll get there eventually. It's going to take a long time. But as that happens, there will be less of an inflationary pressure. But for now, the Federal Reserve is going to have to buy all of the U.S. Treasury bonds. No other country is really interested in doing that. Who's going to buy them? It's all the Federal Reserve. Right now it is. I'm saying that it's going to be in the future, but they're already at that point. So the Fed is just buying everything. They're willing to kill the value of your money by doing all of this. But one of the effects of the changing mindsets of other nations and their confidence in the US dollar is that the US dollar will fall in comparative value. And this will happen especially if they lower interest rates. In terms of a short-term reactionary result of that, it's not good for the dollar when they lower rates. But as the dollar falls in value compared to every other currency, that means imports cost more. Things that are bought in US dollars cost more, such as commodities. Inflation then gets even worse. Even if you buy a product that was assembled overseas, or you bring in a bunch of parts and components to build the thing here and sell it here, manufacture it in America, the cost of all of that is going to be greater. And this is very depressing. So that's why it's so important to just get a little bit further. I'm going to tell you exactly what to do. But here's how it's going to play out. The government, Federal Reserve, they're all going to overreact. And I've told you before, that's what that video was about that I made about the law of diminishing returns. That's why quantitative easing 18 won't be as effective as quantitative easing 14. they'll just keep coming over the top with bigger and bigger amounts of, here, we're going to help everybody. We didn't do enough last time, so now we'll do even more. Now even more. The law of diminishing returns implies that the overreaction is going to have to be even greater and greater each time. At that point, when we're in a little bit of trouble here, the government's going to swing to the rescue, and we're all going to love it. We're all going to vote them in for doing so. They're going to come over the top with such a massive number. And so if it's not at that point, it'll be the quantitative easing after that one, the next one after that. That's when you see the beginnings of hyperinflation. That's when it's going to start. So, thank you for sticking with me. This is a heavy topic, I know. We're in a heavy world right now. But at least there are some things that you can do about all this that will hopefully help you land in a better situation, or at very least help out some people who don't even have a computer or don't watch YouTube and they don't get this kind of message. They're going to be hungry. Even if you have an elderly neighbor down the road, whatever, they're going to need your help right now. You have the ability to do that. The mark of a person, a government, a nation, is how you treat the weakest among you. Okay, here's what you do about it. Number one, responsibilities first. You take care of your elderly parents, the old dude who lives down the street a little bit. You take care of them. They're going to need your help right now more than ever. Be the hero. And understand that this retirement bomb, and I don't call it a crisis, I call it a retirement bomb because the way it's going to play out. You're standing on a nice clear lake, you're standing on the ice, and all of a sudden there's a huge crack. And then once you get the first crack, it's alarming at first, and you get nervous, you're like, oh, wait a minute, this ice is breaking. And after the first crack, then you expect the second, third, and fourth to come a lot quicker than you waited for the first crack. So eventually you're going to see one of these pensions completely default, go under, and that's going to set off the domino effect. I can't tell you what to do. I can tell you what I would do. I would withdraw all my money from my 401k. I'd stop contributing to it and start contributing to yourself. Put that money, if you want to do this, it's not trading advice. I'm wrong 100% of the time. Put that money into an index fund and forget about it and just wait, or take the money out and invest in things that are going to increase in value, such as gold, things that are going to help you out a lot. I believe that there's going to be a fracture or a distinction between the people who owned a little bit of gold and the people who didn't. In the future, I believe people who own some precious metals will come out on the other side of all of this in a lot better shape, even though it's going to be a very difficult situation for everybody. But understand that all of these things coming together, all these moving parts, are implying that there's going to be some damage or some pain for stocks, bonds, and the standard of living and your very quality of life. When there's less money going to the people who are expecting it, and as they spend less money anyways, as they age, that huge 23% portion of the American population is getting older every day. I guess we all are. Economic growth will slow. And then what I say here in the script is I say businesses will suffer during an instigated recession. Instigated meaning that it didn't need to happen and it was caused by people who don't know what they're doing with all this stuff. The people who are given the honor of taking care of your retirement savings, they tried their best. They came along, they go, hey, it was already a mess when I got here. That's how they're going to get away with the fact that none of this is being taken care of properly or dealt with effectively. At that point, a lot of businesses suffer. Unemployment will go into double digits, and possibly very quickly. I'm not saying now, I'm saying as this retirement crisis, this debt bomb for people who are begging on a pension, when that all plays out to the fruition of where it's going, that's when you're going to start to see businesses lay people off like crazy, huge unemployment. And an ongoing effect of unemployment, especially among young males, is civil unrest. A lot more crime, a lot more commotion of that sort. At that point, you're going to see a lot of speculative things taking a hit, whether that's collectible baseball cards or some of these altcoins. So I wanted to say, if you have some cryptocurrencies for your retirement and you're banking on that, be very cautious, because if you say, well, the pension crisis doesn't affect me, I've got all these cryptocurrencies, they might suffer as well. The quantitative easing overreaction by the powers that be will kick off hyperinflation, which is why you need to own some physical precious metals. That's one of the few life rafts available to you right now. Even if you own some silver, and then they'll start flailing and doing all these weird things, start talking about price controls, which 100%, I'll mark my career on this, the price controls will backfire in a massive way. Just like when the trade war started, the first thing I said when it was brand new, I told you in that video that the trade war is going to absolutely backfire. And it did. And now price controls happen. They're going to backfire in a big way. Anytime you slap capitalism in the face, it slaps you back. So they're going to flail and do all sorts of stunts, kind of like they are now. They're mentioning the specter of forgiving student loans. Maybe they talk about a debt jubilee. They're going to flail and try all these things and say, like, look, I'm still getting elected. Hey, you guys want a debt jubilee? Okay. Just more stunts like that, and they're going to be flailing. That's the death throes. That's how you know that it's all coming down. So what do you have? A whole bunch of moving parts here. It's very complicated. And what happens when the parts are moving around? Chaos theory dictates that you're going to see a lot more black swans. You're going to see a lot more significant risks, a lot more deterioration in value. But what's the good part of any of this? If there is a good part, a bright spot, all these moving parts also cause friction. And that friction of things moving around like that, that's where opportunities are born. Most people are going to get wiped out by this. Some people are going to enrich themselves dramatically. And that's what these videos are about. That's why you subscribe to these videos. I tell you every step of the way, and I'm going to tell you when these markets get to a capitulation point as well. We're not there yet. That's when you want to load up on the index funds. When it gets to the bottom, and I tell you this in these videos, you're going to have to be very, very active to take advantage of all these opportunities. There'll be even more opportunities than you're possibly anticipating. But I'm going to sum up here. You guys have done awesome to stick with me. I really very much need you to see that FrontLine video about the retirement crisis. You'll be glad you did. And also, Joe Biden made a statement the other day. He touted deficit reduction and he attacks extreme MAGA plan to sunset Social Security and raise taxes. Taxes will be raised. They have to be. And Social Security, they can either default and then sunset it or just sunset it. I think that it's a matter of time. I'm not in favor of screwing over a whole bunch of retirees. I'm in favor of sunsetting any of these awkward programs that are not helping you use all the money you saved up your whole career to have a mediocre or somewhat okay quality of life. They've taken that from you. And I hate to depress you guys like this, but very few people are talking about this. Very few people are seeing it the right way, especially the ones who are elected to be the ones to take care of you. And I'm going to overstep my bounds here a little bit and speak on behalf of the entire Peter Leeds team. But just remember, the Peter Leeds team and Peter himself, that's me, he loves you. You guys are so wonderful. We love helping you guys out. You guys are helping us. We do this for you and because of you.